Wolf Street, again. Again. Why can I not come out here after days of smashing in your face? Real estate, more data, bad news, real estate, bad news, bad news. Why is there more coming at me at record pace? Not only that, now the Fed's Rosengren is worried. And I saw that last name, Rosengren. Commercial and real estate, residential real estate, bubble, once again, a risk to financial stability. It's now a risk to financial stability. Why? I thought everything was good. And the Fed's Rosengren is worried. I'm going to ask some of y'all. Probably most men than women is going to know this, if any. Talking mid to late 1990s, around 2000, 2001 is when this stopped. Do you remember the two guys called the Jerky Boys? Two dudes called the Jerky Boys, and they would prank call people. And, one was Frank Rizzo and Saul. Hi, I'm Saul Rosenberg. I saw this guy, Feds Rosengren. I thought, oh my God, this is Saul. Saul Rosenberg. I've got a phobia. My own shadow's choking me. Oh my God, there it is. It was stupid now when I think about it, but for any of y'all peeps who remember that, just say a little shout out down there if you remember the Jerky Boys. It was funny back then. But I saw that name, Rosengren. I thought Saul Rosenberg. Fed Saul Rosenberg is worried. He's worried about his shadow choking him. The Fed caused it, but it won't do much to contain it. Last year, Boston Fed President Eric Rosengren, considered a dove, dovish view, on the Fed's policy setting committee, started warning. When? I'm sorry, when was it? Last year. No kidding. Started warning about the commercial real estate bubble in the U.S. and what its demise could do to the banks. But in his speech on financial stability on March 22nd in Indonesia, he added what I've come to call housing bubble 2. That's Wolf Richter speaking. And what JSNIP4 calls housing bubble 2.0. Same number, right? To his ever more emphatic concern. So, number one, are you over in Indonesia on our dime or your own dime, like vacation, speaking engagement kind of a thing? And why aren't you over here giving some speaking engagements to tell the people in this country, the one where you're supposed to be working, about this issue? Why are you talking in Indonesia? Because maybe they'll listen? I don't know. Maybe he's telling them, hey, if this happens to you, this is what to look out for. Don't let it happen in the first place. I'm here to tell you I'm a recovering Fed member, like alcoholic. I'm a recovering Fed mindset. And listen, we caused the problem, and we have absolutely no solution to fix it other than to let everything crash down. That's our solution. Order out of chaos. Famous from the Illuminati, right? Order out of chaos. Oh, there's going to be some chaos. I don't know that order's going to come right away. That might be a problem. Like all central bankers, he can't warn publicly about an approaching problem because it could trigger the very problem he'd be warning about. Oh, well, there's my answer. Jay Snip, shut your mouth and read the next sentence. That's why he can't say it over here. I can't do that. I'll lose my job and they'll fire me. And I got a great job working for the Fed, man. In this manner, no one at the Fed saw the last bubble coming. So Rosengren started his presentation, Financial Stability, the Role of Real Estate Values. What do you mean the role? How does real estate value have a role? Let's hear this. By clarifying this, first, I am not here today to predict problems, but rather to suggest we continue working to head them off. What? Oh, so there are problems. Ah. The phrase, continue working to head them off, is ironic because he also pointed out what has caused these problems. Very low interest rates that were wholly necessary and that he strongly supported. But the risks are massive. Rosengren finds that the root cause of the financial crisis was a significant decline in collateral values of residential and commercial real estate and exposures across the banking system that are correlated and sizable. Real estate becomes a trigger for a financial crisis because of its high leverage. For banks, these properties are collateral. When property values tank, the collateral is impaired. Defaults rise, then broader problems spread into the economy. Hang on one second. All right, I had to pause for a second because I was like, oh, I just did that interview with SGT Bull. I was on his channel. He's going to put that up tonight or tomorrow, which, again, tomorrow is the next day, so maybe the day before tonight for you. And I'm like, oh, I had to change my mic for that conversation. And I just did a video, and this is my second video. Please don't tell me I did it again, where I'm talking and it's not being recorded and I have to redo my videos again. I'm going to be pissed off at myself. I'm about to punch myself in the face. So what I can't tell right now is which microphone I'm on. But I'm on one of them. It looks like... Is it? It might be the... It is. It's the webcam. So I got my nice mic here, and you're listening to the webcam, so I'm not sure what my voice is going to sound like. But my third video will be fixed. Sorry about that. The phrase continue working to head them off is ironic because he also pointed out what had caused these problems, very low interest rates that were wholly necessary and he strongly supported. But the risks are massive. Rosengren finds that the root cause of the financial crisis was a significant decline in collateral values of residential and commercial real estate and exposures across the banking system that are correlated and sizable. Real estate becomes a trigger for a financial crisis because of its high leverage. For banks, these properties are collateral. When property values tank, the collateral is impaired. Defaults rise. Then broader problems spread into the economy. Property owners experience a reduction in income. Homeowners see their paper wealth evaporate and financial stress rises. At some point, banks begin to fail. And this chart shows the number of bank failures regardless of size. In the decade before the financial crisis, the banks had become huge. Thus, fewer but huge banks failed. So, I want to show you this. This chart is from 1987, 88-ish. Do you remember the savings and loan crisis? Some of you do, some of you don't. Interesting research because it's pretty much the same thing we're going through from 2008-9. Happened back then. And when you look at this chart, you say, well, here's 2008 and 2009 over here. This is tiny. This is tiny compared to the savings and loan crisis. No. Just wait a second. The data includes failures and assistance transactions of commercial banks, savings banks, and savings and loan associations. S&Ls are included beginning in 1980. Now, here's an interesting chart. But when these fewer huge banks failed, 2008, 2009, all heck broke loose. This chart shows the asset values of the failed banks just adjusted for inflation. So here's the 86, 87, 88, the huge blip up here on this chart. Oh, it looks terrible. That's how many number of banks failed. Oh my gosh. But then you have, and then again, this isn't failures, but assets of the failed banks in real terms. So wasn't a whole lot of money, a whole lot of worry here. 2008, oh my goodness, was there a lot of money in those failed banks. Too big to fail. Again, should have broken those turds up, but they didn't. As property prices plunged during the financial crisis, the balance of CRE loans that were 90-plus days delinquent soared to over 7% of outstanding balances, and delinquent home mortgages soared over 8% of outstanding balances. Real estate has a significant financial stability implication because real estate tends to be leveraged by the owners, and those loans represent a significant exposure for financial institutions that are themselves highly leveraged. And as I say, leverage is great when the prices are going up and everybody's making money. But they're, like Warren Buffett says, they're weapons of financial mass destruction when they're coming down. That leverage will destroy you. Of course, he made that comment on derivatives, but either way. As losses from these assets, or the loans, hits the bank's capital, the banks shrink their lending, which crushes economic activity and also makes it harder to sell properties as potential buyers cannot find banks willing to lend even at depressed prices. Liquidity in the property market dries up. And the magnitude of this today? Financial institutions hold 3.8 trillion of CRE loans, including multifamily residential, and $10.3 trillion of home mortgages. So this is a $14 trillion problem. The 3.8 trillion of CRE loans are primarily held by banks, 2.02 trillion, which is about 53% of the total. Life insurers, 460 billion, or 12% of the total. Government-sponsored enterprises, GSEs, which include agencies such as Fannie Mae, Freddie Mac, etc., and agency commercial mortgage-backed securities, 521 billion, or 14% total. And finally, non-agency commercial mortgage-backed securities, another $500 billion, 544 billion, or 14% of the total. Hold on. As a matter of fact, I didn't realize, I try to hit my mute button when I gotta clear my throat or cough like that. The fact that you're listening on my webcam's mic means that a second ago when I thought I was slick and pressed my mute button on the mic, means you just got blasted with my cough. Sorry about that. Among the banks, smaller banks, less than 50 billion in assets, hold the lion's share of these CRE loans, 1.2 trillion dollars worth. Larger banks with over 50 billion in assets actually hold only 767 billion. So in other words, the smaller banks are terribly exposed to CRE. This comes on top of 10.3 trillion in home mortgages, of which taxpayers, via the GSEs, government-sponsored entities, Fannie Mae, Freddie, etc., are on the hook for $6.3 trillion. Smaller banks for $1 trillion, and larger banks for $1.6 trillion. That $14 trillion of real estate debt is why real estate can trigger financial crises, and while real estate bubbles, when they implode, are so pernicious. And CRE lending has continued to surge. For Rosengren, the numbers are worrisome. Over the past year, holdings of commercial mortgages by the banking sector have increased 8.9%, while bank holdings of multifamily mortgages have increased 12%. This growth has occurred while bank supervisors have been cautioning about the potential risks emanating from the high valuations in some sectors of the real estate market. But the impact of the guidance from regulators over the past 2 years about the risks of lending to a sector in a full-blown bubble has been modest, he said, as lenders continued to support soaring prices, particularly in the apartment sector. And this chart shows the price increase by sector adjusted for inflation. Prices of apartment and office buildings have soared above the crazy peak of the prior bubble. Note that retail, the light blue line, is starting to strain under the collapse of brick and mortar retailers. So again, apartment, the apartment, look at this, the dark blue, goodness. U.S. real estate commercial price, property price indices by property type. Apartment, rent, etc. It's out of control. But retail, you can see where the retail apocalypse has started, as I've been covering here recently. The indices, adjusted for inflation via the GDP deflator, are based on repeated sales of properties of 2.5 million or more. The problem with apartments is that rental income faces the reality of maxed out consumers and of a lot of new supply coming on the market. Though rents have soared over the past years, they have not soared nearly enough to keep up with the price increases of apartment buildings. As a consequence, cap rates, net operating income divided by the price of the property, have reached the lowest in 16 years. So what can be done about it? Raising rates significantly would stop the price increase and reverse the whole thing, but rates won't rise enough. According to Rosengren, he says there is the possibility that equilibrium interest rates may remain relatively low. This would require a greater emphasis on macroprudential tools if valuations became a source of concern. However, with limited macroprudential tools available and only a modest price response to guidance, it is prudent to keep a healthy, ongoing focus on the sufficiency of these tools and their ongoing enhancement. So in other words, rate increases may not be enough at the equilibrium interest rate to deal with this bubble. Guidance hasn't worked so far, and macroprudential tools are too limited. So reading between the lines, it appears that the real estate bubble is once again putting financial stability at risk, but the Fed, which caused this bubble via low rates and quantitative easing, is now nudging up rates too slowly and too late to an equilibrium rate that it knows is too low. And as this bubble runs its course toward a crisis, the Fed will once again pretend it isn't happening. Let's hope that the problems piling up in the used vehicle market and their impact on new vehicle sales, automakers, 1.1 trillion in auto loans, and auto lenders is just a blip. And in case you're not sure about that, he says, read this article. Is the sound of the bottom falling out? Is this the sound of the bottom falling out of the real auto industry? So as usual, I will absolutely post this link in the description box. Everywhere I look, and I don't even have to try, the data, hard data, again, not soft data. Janet Yellen, we have noise. There's noise in our data. You know, there's a lot of noise. What the hell does that mean, Janet Yellen? Noise. Only noise I hear is coming out of her mouth, like I said in my last video or a couple videos ago. It's the only noise we ever get from the Fed. Well, you know, we're really data dependent, and well, when you look at it, your way you say you look at inflation, and so you can keep a cap on it and let it rise when it needs to rise, you've changed the damn method over 20 times in the last 25, 30 years. Because each time, if you went the next year and said, let's use that same model again, this time it's going to look like we got inflation. We don't want inflation. So let's not use that model. Let's change the model. We'll look at used car tires and, you know, banana peppers, and that'll be our, not that they do that, but I'm being a little extreme. That'll give us a good idea of inflation. Okay, I'll say it again. Food costs, groceries, etc. Energy bills, electricity, etc. Those are the things we should be looking at. What's your water bill like? What's your electric bill like? What's your rent like? Speaking of inflation, or, you know, mortgages potentially, but especially rent. Well, we don't look at that stuff. We don't really look at that stuff. We look at, you know, the time the month the sun comes up, this particular day. Actually, I would not be surprised if I would like to go to the Federal Reserve, you know, where they do all the big secret discussions and we got to look at all the data. And they sat down. Would you love it if you found out you sat down? Magic 8 ball. Should we raise interest rates by more than 0.25% first quarter of 2017? Oh, Janet, I don't want to look. Janet, look for me, Janet. Better not tell you now. Oh, okay. Magic 8 ball. We don't want to go above 25%, as you just said. Magic 8 ball. Should we do a 0.25% rate this time? Signs point to yes. Okay, yeah. Guys, let's go ahead and have the FOMC meeting. Let's go ahead and get the reporters in here. We made our decision. Could you imagine? I bet that if you did take the Magic 8 ball in there and just shook it, it would be just as good. Whenever it told you the answer, if you asked it yes or no, it would be just as good as what the Fed's decisions have been. They don't know what the hell they're doing. Okay? I'll say it again. This cannot possibly end well. Bubble, 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 bubble. And bubble inside a bubble inside of a bubble. How many bubbles do we have now versus the last recession? You know, the Great Recession, as they call it now, 2008-9. Because that was a big real estate bubble, mostly. And yeah, stocks were affected too. But how many bubbles trying to fix that have they created? A whole bunch more. And they've grown to epic proportions. Not going to go well. Take care.